need you to lock in for the next few minutes, because what you are about to hear is not a boring regulatory footnote or a routine policy update from Wall Street. This is a direct threat to the information you depend on to protect your hard-earned money. If you aren't paying attention right now, you will be paying for it later. On March 16, 2026, a bombshell report hit. The SEC is preparing a formal proposal to eliminate mandatory quarterly earnings reporting. Think about that for a second. For the past 56 years, every publicly traded company in America has been required to open its books to you every 90 days. Now they want to reduce that to just twice a year?
Market's looking strong today.
Why are they quietly
Indeed, those
dismantling
industrials
this
are
protection
climbing. Hold on,
right
I'm
now?
confirming the trade.
History tells us exactly why, and the answer is not pretty. To understand what we are about to lose, you have to understand why quarterly reporting was created in the first place. It starts with the tragedy of 1929. In the 1920s, the American stock market was a complete black box. Companies had no legal obligation to disclose their finances transparently. Investors bought stocks based on whatever a company chose to tell them. The result? Rampant fraud, easy credit, and a system built on a total lack of information. In just 48 hours during Black Monday and Black Tuesday, $14 billion in market value evaporated, wiping out the futures of thousands of families. When Congress investigated, the answer was simple. Companies had operated in the dark. This led to the Securities Acts of 1933 and 1934 with one guiding philosophy: sunlight is the best disinfectant. By 1970, the SEC realized 1 year was too long for a company to deteriorate before investors found out. So they mandated the Form 10-Q every 90 days. Eliminating this isn't just cutting red tape. It is returning us to the structural conditions that produced the Great Depression. The official argument from the SEC is that quarterly reporting creates short-term pressure on CEOs. It sounds reasonable, but look at the structural reality underneath. When you eliminate the obligation to update the public regularly, you don't eliminate the incentive to mislead. You simply extend the window inside which misleading you is possible. 6 months is a very long time. A company can start rotting in January, but they won't have to tell you until July. By then, the insiders will have sold. Institutional investors with deep access will have repositioned. And you, the ordinary person holding stock in a retirement account, will be the one left holding the loss when the truth finally comes out. We don't have to guess the outcome. This experiment was run in the EU and the UK in 2013 and 2014. Academic research found that reducing reporting frequency did not encourage long-term investment. Instead, it widened the information gap and led to sharper, more sudden price crashes because bad news was allowed to accumulate for months. Some say fraud happens even with quarterly reports. True. And that is exactly why we need more sunlight, not less. Look at Enron in 2001. It was the 7th largest company in the US. They filed quarterly reports and were audited by a top firm. Yet they still hid billions in debt through complex accounting. Or WorldCom, which inflated earnings by $9 billion by simply reclassifying expenses. If these massive frauds could happen inside a 90-day surveillance system, imagine what will happen when companies have 180 days to cook the books before they have to show their face. Every major financial fraud in US history happened because the information gap was wide enough to let problems compound invisibly. The SEC is now legally widening that gap. This is the most critical piece of context that the financial media is ignoring: the state of corporate debt. American corporate debt now exceeds $14 trillion. Much of this was borrowed when interest rates were near zero. Now, that debt is coming due and must be refinanced at much higher rates. This is what analysts call the refinancing wall. Many companies are under serious financial stress right now. Their incentive to delay bad news and manage their earnings to look healthy is at a decade high. And right at this moment, the proposal to reduce reporting frequency arrives. That is not a coincidence. That is a pattern. Before the information environment shifts permanently, here is how you can protect your money. 1. Review your holdings. Identify companies that are not consistently profitable or have high debt exposure. These are the highest risk positions if 10Q protections are weakened. 2. Track insider trading, Form 4. While earnings reports may become less frequent, insiders are still required to report their trades within 2 business days. Watch what they are doing with their own money. 3. Price risk differently. If a company chooses to report only twice a year, treat that as a structural increase in risk. You are accepting a longer window of information blindness, and that deserves a higher risk discount. 4. Speak up. The SEC is required to accept public comments. Don't think your voice is useless. Retail investors can and have shaped final rules in the past. History is not subtle about what happens when you remove the sunlight. 1929, Enron, 2008. It's the same script every time. Transparency is called a burden until its absence creates a catastrophe. If a company you own stops reporting every 90 days, are you still willing to bet your financial future on them? Let me know in the comments. Stay sharp, stay informed, and stay ahead of the curve. Don't forget to subscribe to track the next steps of this SEC proposal. I'll see you in the next video.